Hello again, everybody. This is Dr. Wright. Welcome to your second online module for ManEc/Fin 453. Today we're going to practice identifying market anomalies using pivot tables. Let's locate ourselves in the map for the online modules for this semester. You can see that we're right here in the second module, identifying market anomalies using pivot tables. The deliverable is going to be an Excel spreadsheet in which you identify some calendar time anomalies using pivot tables. Let's also briefly review what the overall objectives are for this part of the course, specifically the online modules. You can see here our primary goal is to review, teach, and invite you to apply important principles and models from financial theory in order to give you opportunities to enhance your proficiency in the following Excel skills. And you can see a list of Excel skills here that we want to give you an opportunity either to learn or to practice. Today in Module 2, we want to focus specifically on pivot tables. Now, many, if not all of you, have been exposed to pivot tables in the past, so we're hoping that today is more about practice than it is about introduction. We want to give you an opportunity to practice pivot tables in the context of market anomalies. So our goals for the second module are very simple. We want to review the basics of how to use pivot tables in Excel. We want to review the basics of market efficiency, a very important concept that everyone should have been exposed to. We want to review a small sampling of the most common market anomalies that exist, another subject to which all of you should have been exposed in previous courses. And we want to give you an opportunity to use pivot tables to identify a handful of the calendar time market anomalies that exist. Some of you have had some exposure to that in the past. That's okay. Practice is never a bad thing. Before we dive into the market efficiency and the market anomalies review, why don't we jump straight to Excel and review the basics of how we can use pivot tables in Excel to both aggregate and cut and slice data in a very efficient manner. Let me give you a first example here. I have downloaded all of the quarterly dividends that Bank of America has paid its investors going back to June of 1986 through December of 2012. Like I said, these are quarterly dividends. Often in finance, what we want is we want annual dividends. So obviously there's a hard way that you could aggregate these dividends, is you could do something like this. You could say, okay, well right there, let's just add up the last 4 quarters of dividends. Let's do that the last dividend payment of every year. So that's obviously one way that you could try to figure out what the annual dividend has been from Bank of America. That's fairly laborious. There are faster ways of doing it. And the fastest way to do it, I think, is to use a pivot table. Again, there are other ways to do it. You could use the sum-if function. That's a pretty efficient way. But I want to show you specifically pivot tables today. So what you would do is you would come up here to Insert, a new pivot table. And you can see that oftentimes it will already know what data you're trying to bring in. So it automatically captures the table, the data table for us. I want to put our pivot table in a new worksheet, so I'm going to click that option over here. I'm going to click on New Worksheet, click OK, and it's going to pull up a screen that looks like this. Now what we can do is we can drop any of our 3 column headings into either the row label, the column label, or the content of the table. A very simple function that you can do here is we want to aggregate the dividends by year. So we would make the year the row, and you can see that it's got a row representing all of the years in our sample, and then just put the dividends as the content of the pivot table. And you can see that right there, it has, what it's done is it has aggregated all of the dividends paid each year. So that right there represents all of the dividends paid in 1986. Down here you can see all the dividends paid in 2012. So this is a very efficient way to aggregate those dividends, and you can see quite clearly what's happened over the course of Bank of America's history. Starting in '86, they actually had a pretty extended stretch of time in which they were steadily increasing dividends. Those dividend increases really heated up in the early 2000s, going from $1 to over $2.40, and then the financial collapse occurred in 2008, and dividends were essentially slashed to 0 and have not recovered since. Just one demonstration of how you can use pivot tables in a real-world setting. Let me give you one other demonstration. So I'm a teacher by profession, and so I collect all sorts of data related to the classes that I teach. I have scrubbed some of this data so nobody would be able to figure out what class this was that I taught. But this is actual data from classes that I've taught during my career. And you could see I had 3 sections that I taught of this class. I also kept track of whether or not they were male or female, and I kept track of the final course grade. So I might be interested in a few things. I might be interested to see if males or females are outperforming in my class. Maybe my teaching style is connecting better or worse with one of the genders. I also might be interested to see if my teaching style was different across the sections. So am I getting cross-sectional variance in terms of the 3 different sections? Pivot tables would come in very handy in this case. So I'm going to go ahead and insert a pivot table. I'm going to highlight all the data. Again, I want a new worksheet. I'm going to click OK. And the first thing I'm interested to know is I simply want to know, was there any cross-sectional variance? So I'm going to put the section as my row labels, and I'm going to put the final course grade as the content. But the problem here is it's adding up the final course grades. I want to know the average. So down here I'm going to click on sum of final course percent. I'm going to go to value settings, and I'm going to choose average instead of the sum. I'm going to click OK, turn that into a percent. And you can make an observation here. You can see that it appears that the first 2 sections had very similar average final grades. The third section had slightly lower. Now, we don't know if that's a statistically significant difference. We would need to do some ANOVA, or you could do a simple t-statistic comparing against this section and then against that section, or you could do an ANOVA analysis since we have 3 groups. All I mean to say is we're not sure if that's statistically significant, but this data table, this pivot table, is actually giving me cause to think that I should go and investigate this and discover if it is statistically significant. Now, it could be that maybe there's something I was doing different in this class. Maybe it's a professor issue, or it could be a different set of students in that class. Whatever the reason, this pivot table is showing me that I might want to go investigate and figure out if something was going on there. I might also be interested to know if there's a gender difference. So I could get rid of the section and I could replace it with gender. Do a percent, and you can see that the males averaged 89.65% in this particular class, while the females only averaged 86.25. Now, one thing that comes to mind in this case is you could have large outliers influencing the data. So another thing that you can do is look at the number of observations that you have. So I'm going to add a field down here into the content of the table. I'm going to go to value field settings, and this time I want count. And I don't want it to be at percent, I just want it to be a general number. You can see I only have 12 females, I have 75 males. Now if you have a sample of 75, that number probably isn't being heavily influenced by outliers. That number probably is being heavily influenced by outliers. And if I see any outliers, I'm going to go and eliminate those. Now I'm not going to show you the actual grade that's the outlier because I don't want people to be able to identify who it was. Okay, so all I did was I went and deleted one student's score. It was a female who happened to have an outlier score on the bottom end. I deleted that one outlier. I came up here to the Pivot Table Options tab, clicked refresh, and you can see once I do that, the males and the females have almost exactly the same average in the course. That makes me happy. I wouldn't like to see that one gender is outperforming the other. At least I wouldn't like to think that it was my teaching style that was causing that. So now another thing that we could do is we could actually break this down by section. So we could do this. We could put section back in the row, and we could put gender in the columns. I'm going to get rid of the count because I don't need that. And you can see it looks like this. I might get rid of that blank and get rid of that blank and turn it into percents. So you can see that what I've done now is I've sliced this data a number of ways. Here's my 3 sections. In each of the sections, here's the males and the females. And let's see, in section 1 they look very close, in section 2 they look very close, and in section 3 they look very close. So I'm happy to see that within each of the sections, the males and the females appear to be performing on about the same plane. although like I said before, we did notice that I had some cross-sectional variation, so it would probably be worth investigating what I did in section 3 that may have been different than what I did in the other two sections. So that's just another demonstration of how useful these pivot tables can be. You can aggregate data, but you can also slice and parse data very quickly, so it's a very useful function. Let's jump back into the PowerPoints here. So we just reviewed the basics of how to use pivot tables in Excel. They're very simple. Now what I want to do is review some finance concepts with you, and then we'll use pivot tables to actually investigate some of these finance concepts. So let's take a minute to review the basic principles of market efficiency. First off, we make a note that efficient markets are desirable because efficient markets help to facilitate the optimal allocation of resources within an economy. The whole point of a capitalist economy is that we believe markets are more efficient at allocating resources, scarce resources, than our central planners. That is based on the assumption that the markets are efficient. In other words, the prices that we see in a market are reliable and that they accurately capture the relevant and available information. Generally speaking, we identify 4 levels of market efficiency. The first level is weak form market efficiency. A market that is weak form efficient will nearly instantaneously and largely accurately price all material information contained in past stock data. So if you look at any past prices, returns, volume, or any other past stock return data, a market that is weak form efficient will have all of that information captured into the current prices. The next level is semi-strong form efficiency. A market that is semi-strong form efficient will nearly instantaneously and largely accurately price all publicly available material information. So a market that is semi-strong form efficient will be very good at pricing in and capturing any new information that is released to the public. Largely we're talking about news stories or earnings announcements, any new information that gets made publicly available. A market that's strong form efficient is a market that nearly instantaneously and largely accurately prices in all privately known material information. So this would mean if a CEO of a company has some piece of inside information that few other people know, a strong form efficient market would be able to price that in accurately and very quickly. And then the highest level of market efficiency, known as perfect market efficiency. So perfectly efficient markets would instantaneously and accurately price in all material information. So these are the 4 levels of market efficiency. Again, we believe that efficient markets are desirable because they help to facilitate the optimal allocation of resources within an economy, which helps to grow the economy, which benefits everyone in that economy. Now, a key point about market efficiency is that in an efficient market, an investor should not be able to generate alpha using information that is presumably accurate and quickly priced. For instance, in a weak form efficient market, a market that instantaneously and accurately prices all material information contained in past stock data, an investor should not be able to create an investment strategy based on past stock data, prices, returns, or volume that generates alpha. So not only is market efficiency important from an optimal allocation perspective at the macroeconomic level, market efficiency is hugely important to investors because depending on your perspectives of how efficient a market is, it should drive your investing paradigm. And generally speaking, the more efficient you believe a market is, the less actively you're going to invest. You would embrace more of a passive investing strategy, something along the lines of modern portfolio theory. So it's a very, very important topic, market efficiency, and trying to peg precisely how efficient a market is hugely important, both to policymakers and to investors. Related to market efficiency, there's a topic known as market anomalies. And actually, market anomalies are any empirical findings that suggest that markets are not efficient on some level. So I like to think of market anomalies as either trends or trading strategies that just can't be explained in an efficient markets hypothesis framework. Now, there is a whole slew of market anomalies out there. I just wanted to refresh your memories on a few of the most common market anomalies. I have a few categories. There are other categories that we could look at, but I have firm characteristic anomalies, announcement anomalies, and calendar time anomalies. Some of the more common firm characteristic anomalies are the size effect, that small stocks outperform large stocks. The value effect, this is defined a couple of different ways. One of the more common ways that it's defined is book to market. Generally speaking, high book to market stocks outperform low book to market stocks, just like low PE stocks outperform high PE stocks. Those would both fall under the value effect. Momentum, which simply suggests that stocks that have performed well recently generally continue that trend. Likewise, stocks that have struggled recently continue that trend, at least over the next few months. So the 52-week high is an interesting anomaly in which it was discovered that stocks whose prices are closest to their 52-week highs outperform stocks whose prices are farthest from their 52-week highs. So those are just a handful of firm characteristic anomalies. Some of the more widely known announcement anomalies are post-earnings announcement drift, that following an earnings surprise, in other words, following an earnings announcement that is different from consensus analyst estimates, not only do we get an immediate stock price reaction, but we get a drift in that same direction over the next 60 days. We also have the S&P listing effect, which is that stocks that are being added to the S&P 500 enjoy a pop, a positive stock price reaction upon the announcement of the news. We also have the repurchase announcement effect. So when a company announces that it's going to repurchase its stock, we know that that stock price generally also enjoys a positive stock price shock. Those would be some of the more common announcement anomalies. There are also calendar time anomalies. One of the most famous calendar time anomalies is the Monday effect. And this is simply the finding that stocks have low returns on Monday relative to other days of the week. There is the January effect. The January effect is the surprising finding that small stocks generally enjoy abnormally high returns the first few trading days of the year. The holiday effect is simply the finding that stocks, generally speaking, have abnormally high returns the day before holidays, specifically holidays on which the markets are closed. The October through March seasonality effect is the finding that the lion's share of positive returns in the stock market occur between the months of October and March. Now, I should say, there are reasonable explanations for many of these anomalies, but generally speaking, these are still anomalies in the sense that they don't make sense in an efficient markets hypothesis framework. Now again, there are explanations, but the explanations are not always consistent with efficient markets. So we call these anomalies because they are difficult to explain. They seem to be irreconcilable with the idea that markets are efficient. So what I wanted to do today is we want to demonstrate to you how you can use some Excel tools in order to very quickly identify some of these calendar time anomalies. So that's what we're going to do. Let me briefly explain the deliverables associated with this assignment. You're going to use daily data for the S&P 500 from 1960 through the end of 2012. Please note this is different than what I'm going to do in the video. Your deliverable will be an Excel file with 5 tabs. You'll have a data tab and then 4 tabs demonstrating the 4 calendar time anomalies that we're studying. Please note you must complete the assignment individually. It must be submitted via the Learning Suite, and please refer to your instructor for the due date. Let's go and execute this together now in Excel. We're going to leverage on a tool that we made available to you and demonstrated to you in the first Excel module. This is the Excel file for downloading daily data from Yahoo Finance. I'm going to download data for the Russell's 2000. This is a small cap index, so these are largely small stocks. I'm going to go from January of 1988 to June 30th of 2012. Please remember you'll be doing this for the S&P 500 from the first trading day of 1960 through all of 2012. Once you put in your ticker symbol and your start and end dates, you simply go up to View Macros and you just run this macro and it's going to pull in the data for you. So now that I have my data, I'm going to go ahead and save this. Once I've saved it, I'm going to start manipulating the data and then we'll get into the calendar time anomalies. The first thing that I recommend is simply sorting all of the data. By hitting Control Shift arrow right, I highlight all of the columns by continuing to hold down Control Shift, and then I hit the arrow down button. I highlight the entire data set. You can see I don't actually need this blank row highlighted right here. So I'll come up one row, and then I will hit Alt-DS, which will allow me to sort the data. Those are some hotkeys. I'm going to sort based on date from oldest to newest, and you can see it is sorted as such. Now I'm going to calculate the return each day. I'm going to use continuously compounded returns. This is something we'll talk about in greater depth in the next Excel module, so don't panic if this doesn't make perfect sense to you. So in order to get the daily returns, I'm going to take the natural log of today's price divided by the previous day's price. Technically, since this is an index, it's not really a price, it's just representing a level, but that's okay. You can think of it as a price. So continuously compounded returns says I just take the natural log of the ratio of today's price divided by previous day's price. That gives me today's return. I shoot that all the way down the line. And again, please don't panic if you don't understand the logic behind that. We will cover that in the next module. I want to turn these into percentages, so I'm going to hit Control Shift and the number 5, which turns it into percent. I'm going to give it a few decimal places. And so there are the returns every day to the Russell's 2000. Now what I want to do is I want to identify the Monday effect, the January effect, the holiday effect, and the October through March seasonality effect. So I'm actually going to need 4 more columns. So I highlight 4 columns. I hit Control Shift plus and it creates the columns. I want to know the year, the month, the day of the month, and I want to know the day of the week. These are very simple. I'm just going to use the year formula like so. Don't worry about that. It's a formatting issue. We'll fix it momentarily. I'm going to use the month function. I'm going to use the day function. And I'm going to use the weekday function. Now I'm going to hit Control 1, which brings up the wizard that allows us to format the cells. And I'm going to make these general numbers and center that. And you can see, in fact, that we have 1988. It's the first month, it's the 4th day, and it's the 2nd weekday, meaning that's a Monday. I'm going to shoot those all the way down the line. Just double click on the black dot and that takes it down. So now we have our data tab. I'm going to go ahead and label that as such. And what I want to do is I want to try to isolate the Monday effect, January effect, holiday effect, and October through March seasonality. So we're going to insert a pivot table. You can see that it's already highlighted all of the data. I'm curious to know if it's going beyond where we want it to. It is going 1 row beyond where we want it to. So I'm going to bring it up 1 row. So you can see that I have highlighted all of the data in my table. I'm going to put this pivot table in a new worksheet. And I'm going to call this the Monday effect. So the first thing I want to do is identify the Monday effect. I'm going to grab weekday and make that my row labels. And I'm going to grab the return and make it my column labels. I'm going to change the field setting. I'm going to change it from count to average. I'm going to make those percents by again hitting Control Shift %, giving it a few decimal places. I'm going to format this so that instead of 2, 3, 4, 5, 6, it's going to say Monday, Tuesday, Wednesday, Thursday, Friday. I'm going to hit Control 1. I'm going to go to a custom format, and I'm going to simply type in DDDD, which is going to turn it into Monday, Tuesday, Wednesday, Thursday, Friday. And then I'm going to annualize this. The way I'm going to annualize this is I'm going to take that, and I'm going to multiply it by 52, because there are 52 weeks in a year. Please note, you cannot simply pull that formula down. You have to realize that what it's doing is it's going and getting data from the pivot table, and it's getting data associated with the weekday number 2, because Monday is number 2 when you look at it in terms of weekday. So when we pull this formula down, we need that 2 to change to a 3 and then a 4 and then a 5. So instead of 2, what you can do is you can replace the 2 with that cell. Now you should be able to pull it down. I'm going to again turn it into a percent with a few decimals. we might be interested in centering all of this and perhaps giving it some formatting help. Now, I want us to think for a second. Part of going to college, part of the experience should be to learn how to think critically. We know for a fact there are actually only 50 Mondays in any given trading year. Why is that? Memorial Day and Labor Day. So there's only 50 Mondays in a trading year. We also know that there are only 51 Thursdays. Why is that? Because of Thanksgiving. Now keep in mind there are other holidays, so in any given year there's not probably going to be 52 of the rest of the days because we could lose one due to Christmas or New Year's Day. But this works in a normal year. You'd have 50 Mondays, 51 Thursdays, and 52 of the other weeks of the year. And 52 of the other days of the year. You can see quite clearly the Monday effect. So in an average year, investors lose 4% on Mondays, while they gain between 2 and 3.75% on all of the other days during the week. So the Monday effect is very visible in the data set that I have, which again is the Russell's 2000 from 1988 to 2012. Clearly returns are much lower on Monday than they are on any other day of the week. Why don't we next turn our attention to the October through March seasonality effect? I'm going to again insert a pivot table. Make sure it's highlighting the right data. It is. I want a new worksheet. Great. So we'll just call this October through March. So the October through March seasonality effect is simply that the lion's share of the returns in the U.S. stock markets occur between the months of October and March. So let's go ahead and put our months in here. And then let's put return in. And again, let's make it the average, not the count. Turn those into percentages. Give them a few decimal places. And center it. Actually, it might be helpful to do two pivot tables here. So what I might want to do is this. I might come back to Insert Pivot Table, but I want to put in an existing worksheet, and where I want to put this pivot table is right next to the pivot table we just created. So I'm going to do the exact same thing. I'm going to put month right there. I'm going to put returns right there. And I'm going to do the average of those returns. And again, I'm going to turn those into percents with a few decimal places. Center all of that. And now what I'm going to do is over here, I'm going to get rid of January, February, March, and October, November, December. Over here, I will get rid of the opposites. So I will keep October. So I will keep January, February, March, October, November, December, and we will do this. Now you can see there's April through September. The average daily return is 0.006%. So let's go ahead and annualize that. And let's assume there are 250 trading days in a year. So what would that mean? That would mean if through the whole year, on average, each day you earned what you earn in a typical day in the months of April through September, then in a year you would earn 1.42% in the Russell's 2000. How does this compare with what you earn January, February, March, October, November, December? In other words, October through March. Again, let's annualize this by multiplying it by 250. And let's turn it into a percent with a couple of decimals. So you can see it's a stark contrast. So over here in the months of April through September, you would earn 1.42% per year if you got that same return throughout the whole year that you get in those 6 months. Over here in October through March, if you could earn the whole year what you earn on average on a typical day in October through March, you would get an annual return of 13.75%. So we do see pretty strong evidence of this October through March seasonality. that the lion's share of the returns in the stock market come in the months of October through March. Let's now turn our attention to the January effect. So back to the data tab, let's insert another pivot table. Now remember, the January effect is that small stocks, generally speaking, have abnormally high returns the first few trading days of the year. I'm going to identify this by putting the months in the columns and the day of the month in the rows. Then I'm going to drop the return into the content of the table, and again I'm going to take the average return. I'm going to highlight this, turn it into a percent with a few decimal places, just like we've done previously. And we could also shrink those columns down to size. So the January effect says that, generally speaking, small stocks get a nice positive pop the first few trading days of the year. This would be January right here. This would be January 2nd, 3rd, and 4th. You can see that we do not, in fact, see the January effect in the data set that I have. So remember, I have the returns to the Russell's 2000 index from 1988 to 2012, and it turns out that in that data set we do not see evidence of the January effect. We get a little bit of a pop here on January 3rd, but it's sandwiched by some really highly negative returns. Now, one thing that's interesting to note, we do see some very strong returns at the end of December. Some people would make the argument that what we're actually seeing is a shifting of the January effect from January to the end of December. There are reasons why that could take place, especially if you believe that markets are relatively efficient. However, I'm not going to try to make that argument. I'm simply going to say that over the last 20 years or so, in the Russell's 2000, we have not seen strong evidence of the January effect. So the last thing that we want to do is we want to try to identify the holiday effect. Now remember that the holiday effect is simply the finding that stocks, generally speaking, have abnormally high returns the day before a holiday, especially if it's a holiday that closes the markets. Back to the data table, insert a pivot table. This is going to look very similar to what we did with the January effect, because it turns out that exact same table structure will allow us to identify the holiday effect. So we could have just copied and pasted this tab right here, but for the sake of practice, we're going to recreate that pivot table. Again, we're going to drop the day of the month in the row. We're going to drop the month in the column, and we're going to drop the returns into the content, and we're going to change the field settings to average. And again, we'll turn all of that into a percent with several decimal places. We could center it, and we could certainly shrink the column size. So if it's the holiday effect, and let's go ahead and label it as such, then we should see abnormally high returns the day before holidays, especially holidays that close the markets. Well, July 4th is a holiday, December 25th is a holiday, and January 1st is a holiday. So why don't we black those out? So the day before those days, we should see abnormally high returns. There's July 3rd. We certainly don't see abnormally high returns. There is December 25th. That's the day before, so that's where we should see the holiday effect. January 1st is a holiday, so December 31st, we should see the holiday effect. Now, you could throw one other holiday in here, although it doesn't close the market, but you could throw Valentine's Day in if you wanted to. Valentine's Day is December 14th, and you can see the day before. That would be the return right there. Now the question is, do we see abnormally high returns the day before market holidays? First off, we would need to benchmark this. Please note that overall the average daily return to this index over my sample period is about 3 basis points per day. Anything significantly higher than that would be reason for us to think that there is something going on. Let's start here with July 3rd. Clearly that's not higher than the overall average. The overall average is positive 3 basis points. That's negative 7 basis points. So We do not see a July 3rd holiday effect. The day before Christmas, December 24th, we do see returns that are considerably higher than the overall average. We see 22 basis points on average on December 24th, whereas the overall average is only 3 basis points. We don't know if that's statistically significant. I can guess that it is, but we would have to do more work to figure that out. I also noticed that in all of the days leading up to Christmas, starting December 20th all the way through the 24th, we see strikingly high daily returns relative to the overall average. How about the day before New Year's Day? Again, we see 50 basis points relative to only 3 in the overall average. I would say that definitely constitutes a holiday effect. And again, I notice fairly strong returns in the 4 or 5 days leading up to it. So it's almost as if we see a holiday effect 4 days leading up to the holiday. How about February 14th? Well, there's February 14th. The day right before that is 17 basis points relative to 3 for the overall sample. That certainly looks much, much higher than the overall average. Again, we'd have to do more work to determine if that is statistically significant, but it does look economically significant. So I would say that we see definitely moderate evidence of the holiday effect. We certainly see it before Christmas Day. We see it before New Year's Day. We see a little bit before Valentine's Day. Not so much for July 3rd. Okay, so the entire point of Excel module number 2 was to use some important principles of modern finance, but mostly to give you an opportunity to practice pivot tables. I tried to show you how effective and powerful pivot tables can be in a handful of settings. We learned that you can aggregate dividends. I showed you how I can use it to parse data related to the grades in my courses, and then I'm going to have you actually execute it with data related to the S&P 500. You're going to create 4 different tabs, trying to determine if you see a Monday effect, October through March seasonality effect, and January effect, and lastly holiday effect. Remember, you need to use the S&P 500 from 1960 through the end of 2012. You should have a data tab and all of these 4 tabs down here, and I'm interested to see if you can observe in your data a Monday effect, this October through March seasonality effect. I'm really curious to see if you have a January effect, since we don't see it here. And I'm also interested to see if the holiday effect shows up in your data set. Please remember to refer to your instructor for the due date, and we will be together soon in module number 3. Until then, best of luck with the assignment.